Hi, this is Jamie, and this is my brief overview of the financial crisis of 2008. So, the environment and history leading up to the 2008 financial crisis really should be looked at as far back as the stock market crash of 1929 that led to the Great Depression. So what had happened before that was banking had seen a lot of activity and there wasn't very much regulation. And then when the stock market crashed and the Great Depression was put into place, monetary policy had to regulate a lot of things so that way they could come out of it. And this led to a lot of over-regulation and to where banks couldn't really compete with savings. And so people started to bring their money to other institutions, and banks were really losing money and they didn't know what their future was going to be. So 50 years after that, in about the 80s, I think it was 81, there was an act passed that deregulated a lot of the banking industry. This then led to a lot more deregulations over the years up until about 2000, 2002. There was just numerous deregulations, and it got so much to the point to where financial institutions were just starting to regulate themselves, and there was not really a need to tell anybody what was on your books because it was all voluntary. And honestly, what kind of bank that has so many liabilities and assets that they don't really want to share is going to voluntarily give that information to the government? So that's where we ended up being before the financial crisis, was that deregulation was at its peak. There was a lot of acts that were passed by Republican parties during their presidencies in the late 80s and early 90s, and even into when Clinton was president. Even though he was a Democratic president, he was very concerned with unemployment and getting some of these regulations taken off. Honestly, I believe it's for a different reason than a lot of, good for the public, but I'm not going to get into that today. So that was just the history and the environment leading up to what would have caused it. There is a little bit more history, but I'm going to go into that on the next slide. So in the late 1990s and the early 2000s, banks really started to figure out how they could make money off of mortgages. This didn't include buying and selling mortgages or creating more mortgages. It was the trading them as securities and earning money off of their interest. So banks would create mortgages, and then they would take hundreds or sometimes thousands of these mortgages and they would sell them to an investment bank. And then an investment bank would bundle all of these mortgages together, and they would then turn them into a mutual fund or just a fund, and then they would trade them on the secondary market and make money off of them. So with this, banks started to really make some money, and they wanted more mortgages. So they said to the lower banks, hey, I need some more money. I need more mortgages. I need you to get them for me. And then banks said, we've exhausted all opportunities. We've gotten as much loans out as we can. There is nobody else. We don't know what to do. And investment bank said, figure it out. And they said, the only way we could do this is to lower our standards. And they said, do what you got to do. So smaller banks, because they did not carry liability of these loans, I mean, they got the loans and within days later passed all those loans off, got the assets recorded on their bank statements, and they were good. So they were like, okay, whatever. If that's what you want, it's your risk. They're your liabilities. I will get you what you want. And so they started lending to people who couldn't necessarily afford or have the background to have a mortgage. They didn't have credit, they didn't have jobs, they didn't have down payments, and they were like, whatever. They said to give you a loan, I'm going to give you a loan. These are called subprime mortgages. They are terrible. You don't give subprime mortgages. they don't hold any weight. Most likely people are going to default. So when investment banks were making this much money off of all of these mortgages, and I mean like pulling in hundreds of thousands of mortgages all the time, the more money they got, the more greedy they got. And they were like, give it to them however they can. We just want them. So one of the ways on top of just subprime mortgages is that they were giving people, or really talking them into adjustable rate mortgages, because a lot of these people knew that they couldn't afford these loans. They were like, oh, we don't really have the graded jobs. I can't really afford that. And the banks were like, yeah, you can. We'll get you an adjustable rate mortgage. The interest rates are so low right now. Your payments are going to be half of if it was a fixed mortgage. You'll be great. They're nothing. And so these people who had no idea any other way were like, yeah, $800 for a house that's worth $400,000, I'll take it. And so they were all given these adjustable rate mortgages, and it was great until the quarterly updates and the new inflation rate came out. And then their price that they paid a month jumped. And they were like, whoa, wait a minute. And it happened again and again and again. And all of these rates were jumping higher and higher and higher. And then these people couldn't afford it. If they would have been, prime borrowers, they might have had a chance, but they probably might have gone for a 15 or 30-year fixed loan and said, yeah, I don't think so. I'm not taking an adjustable rate mortgage. So they got kind of manipulated into these adjustable rate mortgages. And they were subprime mortgages to begin with, so they just all around weren't good. So after everybody bought these loans, the house prices started to go up because more people want to buy, prices go up, the value of everybody's homes go up. Great. All these buyers were still buying houses, still buying large priced homes. Let's say you bought a home $400,000. Great. You own your house. Everybody's very proud that you, who make $35,000 a year as a single father with 3 kids, can afford your $400,000 house with your adjustable interest rate mortgage. But you have no idea that you really can't afford this because nobody told you. So in the mid-2000s, the housing bubble popped. So they got so high and then it just burst, and the value of homes quickly, it went down. It took a couple years, but the value of homes, people just not able to afford them, the values plummeted. So your $400,000 house that you just bought now is only worth $100,000. And you still owe $400,000 on this $100,000 house. And you really can't afford to pay it anyways, because your payments have gone up tremendously. You probably started out paying $800 a month for your $400,000 house, and now you're up to, $2,100 a month, and nobody in their right mind can afford that on a $35,000 a month a week salary, or year salary. I couldn't afford that with me and my spouse's $70,000 a year salary. I wouldn't do it. $400,000 is crazy. So the bubble popped. Home values plummeted. All these people with subprime mortgages, they just couldn't pay, and they just lost their houses. But then you have all these people who make $100,000, who make $200,000, who own these $400,000 houses, who can pay for their houses. But then you think these people are the ones you want buying your houses and buying loans from you and owing you money. These are the people that you want. They still have the houses. You're still good. But then these people realize, what am I doing? Like, my house is valued at $100,000 and I'm paying $300,000 more than it's worth. I'm going to be under this house for the next 30 years. Like, what am I doing? I'm never going to get this money out of it. I'm just going to let my house go. Like, I'll just file for bankruptcy, and in 7 years, I'll buy another house, and until then, I'll rent one. I know this because this is what my mother did. She bought her house in 2004, and she bought it for about $180,000, and then she had it until 2014 or 2013, I believe. Because she kept it for so long because there was a government program that she was trying to get into that she ended up not getting approved for, but she wasn't paying her rent or her mortgage because of this. So if she hadn't tried to get into that government program, she probably would have been out in 2009. And she left and she rented. So she was renting this whole time. She let her house go. And then this past year, about 2 months ago, her and her husband bought another house, one that they wanted because everything was good on their credit now. All of that is behind them. And they now have a house that is worth it because their other house was only worth $40,000 and they still owed over $100,000. And she was like, I don't think so. I'm not doing this. And they let their house go. So all the values, they dropped. Houses weren't worth anything. Buyers owed too much. And they were like, see you later. I'm not doing this. And well, that really is what started the chain reaction of what happened to investment banks. So once the housing bubble burst and all of these people with these prime sub mortgages and even people who had normal mortgages let their house go, once they were no longer contributing and investment banks were no longer receiving income that backed these mortgage-backed securities. I mean, because you have to have an asset that backs them so that they have value. Then you quickly realize that all of these mortgages that they've bundled and then put on the market no longer are worth what they say they're worth. There's nothing there. They are now liabilities. And so investment banks realized they had billions of dollars in liabilities on their books, and the only thing other to do than that is to go bankrupt. Like, they tried to hide it, but eventually it came out. Investors didn't want to invest. Other banks realized what was going on. The entire thing kind of just pronounced itself, and everybody was like, we're in trouble. And they were like, you have these bad subprime mortgages. We're not buying stuff from you. We're not loaning you money. We're not trading anything with you because we don't want them on our books because we're going to get penalized if we have them. And I'm good. Like, no, we don't have them. Even though secretly they did have them, they just told everybody that they didn't. So that way the Fed wouldn't be snooping around and saying, hey, you got these on your books. So with all of that happening, some of them did go out of business. Some of them realized, I don't have anything, and their people did bank runs, pulled all of their money out of their banks, left them with barely any couple, maybe $2-3 billion at the most. Investors pulled out, their stocks plummeted, maybe left with a couple $100,000 in assets to their name. They were done for. The problem with that was that some of these banks were too big to fail, and if they failed, more than just the banks were going out of business. That meant that the economy most likely would have crashed. And because all of our economies were so intertwined with the United States so heavily investing in other, lesser, newer economies, markets, that if they would have pulled their money out because the economy was failing, those economies would have failed too. So the Fed realized this. They were like, whoa, we have to bail these banks out because if they fail, we all fail. Like, we're all screwed. So they went to Congress. Congress was like, no, I'm not doing that. That led to this massive wave of, investors freaking out, pulling their money out of the stock market. The stock market collapsing almost. It basically plummeted. The Dow Jones went down like 500 points the first time, and they were like 700 something points the second time. It went down. And then Congress was like, oh no, you're right. These banks are intertwined with the stock market and the automobile market, and basically every other market on the planet runs through the financial sectors of banks. Obviously, that's who gives all these different industries loans. That's what supports everything. They have assets from all of these companies that have liabilities that they owe all these banks. If these banks collapse, all the other industries are going to collapse too. So Congress said, yes, bail them out. This bailout, this $700 billion bailout, they said, okay, bail us out. So the Obama administration was like, we got you. And that's what my next slide is about. So stay tuned. So after the banks realized all this was happening and the government realized everything was happening, and they were like, yes, we bail you out. They did this by creating TARP. TARP is the Troubled Asset Relief Program, and that was divided up into 3 or 4 different areas where they bailed out banks, they bailed out the automotive industry because that was pretty messed up. People weren't spending money. There was a crisis of banks not loaning people money to buy cars, and it just affected them so bad that they needed to be bailed out, or 3 or 4 of these large car industries would have failed. So they bailed them out, but in doing so, they were like, we'll get you, but we're going to regulate you too. Like, you haven't had regulation in years. It was so deregulated that it was off the charts insane. You're getting regulations. Obama was like, we're regulating the crap out of you because we're Democrats and we love monetary policy. So they regulated them, which for the most part was great. They needed regulation. The banks were full of corporate greed. They were too big, and it was too much. They needed some monetary policy to come in and fix them. We were in a financial crisis, and the only way to bail it out was for the government to step in. Well done. We're not in it anymore. But at the same time, when they did these regulations, they didn't necessarily do the regulations in favor of any banks. They just regulated all the banks the same. When the small banks, the community banks, the ones in your hometowns, those ones were the ones that were suffering. They didn't have the capital to support themselves from not being able to do certain investments, or, not being able to give loans. They needed the most help. So when Trump came into office, and he's a Republican, and their party is about deregulation because most of them are business owners. Most of them are linked to banks. Most of them are linked to corporate and making profits. And so they're very much about deregulation. So they came in and they were like, we need to deregulate some of this. We need to help our small banks. We need to get our small banks to give business loans to small businesses so they can start thriving and the economy can start moving in these small areas. So they came in, they did some deregulations. The only thing that I don't really agree with they did so much is they did lower the amount of capital that banks do need to have on file, which is kind of the same thing they did in the 80s, and look where that slippery slope led to. So that's the only thing I really am not happy with what Trump's administration did. But other than that, I am happy that small banks were able to come out and benefit from this. So if we want to look at the future and where we're going to be, you have to look at the past and look at the mistakes we've made in the past and see any patterns that have developed. And in the last 100 years, there have been patterns. We had the stock market crash of 1929 and the Great Depression that followed that. And that stemmed from over excessive banking and just the banking industry getting far ahead of what it was really capable of regulating itself. And then after this, the Great Depression and the crash, monetary policy was created and stepped in and said, hey, we need to regulate this. And it did. And then in the 80s, they said, whoa, our banks aren't doing anything. We're not growing. We're not making money. We're just kind of surviving. Let's stop this and let's deregulate some of this. So in the 80s and 90s, they deregulated. And in the early 2000s, from the lack of regulation and all the different new ways to make money, just like in the 20s, they were like, hey, let's do this. So all of this happened and everything built up, and then it crashed again. And we dealt with it. More monetary policy was put in place, and now at a shorter span of only 10 years instead of 80 or 50, we are deregulating and we're having the same patterns. We're having lines on charts match up. We're having inverted curves, and those are definite indicators of recessions that are coming. And if we are anything like we were in the last recession, where the Fed was like, I'm just going to wait and hold off, I'm not going to look at these warning signs, we're going to have a recession. And we have warning signs now because we are at such high growth and such low unemployment and such volatility that if we don't look at the warnings and kind of see if we can fix them beforehand, we're going to have the same thing happen again. It might not be on such a great scale because of the regulations that we do have in place, but we will have one. So if we want to stop this from happening in the near future or in the further future, we need to look at the past and just make sure that we're not making the same mistakes, making sure that we're catching things that could be happening in the future. The Fed needs to get off of its butt and just, pay attention to everything and take action instead of sitting back and watching these financial crises unfold and the people suffering. So if we want to look to our future and we want to see what's happening now and what's happening then, honestly, we're on the same path. We're having the same markers, and hopefully we'll be able to stop the next one based on the knowledge that we're learning from our mistakes.